What is going on, everyone? Welcome to lesson number 4. Today, we are diving into liquidity at last. Congratulations. This is the point right here where you stop thinking and trading like your buddy Joe at your job who's losing a bunch of money and complaining that the market is out to get him and that everything is rigged. Today, we start thinking like the banks. We start thinking like the big institutions, like the market makers, right? And how do we do that? With liquidity, okay? So liquidity itself is a topic that will absolutely require multiple lessons, multiple videos. It is a very layered topic. However, this lesson today is going to give you an overall fundamental understanding of what liquidity is, why we care about it, where we can find it, all of that good stuff. So thank you for being here. I'm excited for you to be here because this is it. This is the king right here. So to begin, what is liquidity? Liquidity is resting orders in the market. That's it. We're done. No, I'm just kidding. But that is what liquidity is. It is resting orders in specific significant places in the market. Okay. Now, before we go any deeper into liquidity, let's rewind. Let's take a step back to one of the most basic foundational aspects of economics. And what is that? If I want to buy something, somebody has to sell it to me, right? If I want to buy a pair of shoes, there has to be a company or a store or a person or someplace online that is willing to sell it to me for an agreed upon price. Now, that sounds incredibly basic, right? Because it is. But as I start teaching you, here's the way I teach. I might start teaching you guys a little bit more advanced concepts, but I'm still always going to trickle in the most blatantly obvious points, right? We might start getting into SMTs and fair value gaps and liquidity concepts, and I'm still going to tell you 1 + 1 = 2. Because in order for you to understand these more advanced concepts, I always like to use very point blank obvious points and analogies for you to be able to properly understand them, okay? So if I want to buy something in life, someone has to sell it to me. And if I want to sell something, someone has to buy it for me, okay? It works the exact same way in the financial markets. If I want to buy a stock or an options contract or a futures contract, which is how I trade, someone has to sell it to me, right? It might appear as if I just click the buy button and it just drops into my account out of thin air. But what is actually happening is if I click buy, someone in the world is agreeing to sell it to me at that given price, okay? Now, to get into a little bit of an analogy when we start thinking about liquidity is this. And halfway through this story, you might be like, okay, what in the actual fuck is this guy talking about? But trust me, it's going to tie everything back into liquidity, okay? Let's say you are traveling solo. You're driving across the country and you're on a motorcycle and it's really hot out and you're going to get thirsty a lot, right? You can theoretically stop at pretty much any exit along the way and get yourself a bottle of water, right? You could stop at a big gas station. You could stop at a restaurant. You could stop at a little rest stop with the vending machine. It doesn't matter. You could pretty much just stop anywhere you want and get your bottle of water. Now, in the same scenario, let's say a big football team with a bunch of staff of 100 people are traveling on that same route. And those people are thirsty as well, right? They can't just stop at any little rest stop with a vending machine because there's only going to be a couple bottles of water there, right? So what do they need to do to fulfill their need for water? They need to tell their bus driver, hey, we need to stop at a very specific exit, drive a few miles off the freeway, and stop at this big grocery store or restaurant, whatever it may be, right? Now, this is probably the point where you're thinking like, holy shit, yeah, what is this guy talking about? Now, let's tie that back into the market. If any random retail trader like you or myself or anybody else wants to get involved into the market, they could basically just sit down at their desk, open up their laptop, sign into their broker, click the buy button at any given time, and be entered into the market within a couple points, right? So when we think about our little analogy there, if I want to stop and get a bottle of water just myself, I could pretty much just stop anywhere because there's the inventory there just for me. Now, when it comes to the big institutions that need to fulfill thousands of orders or multi-million-dollar trades, like the football team who needs to get a bunch of cases of water, they need the market or the bus to go in a very specific place that has the inventory for them to do so. Okay, so where can we find the most resting orders in the market? Well, let's use a very basic example right here. Okay, we are going to draw out a pretty common scenario here, and we are going to imagine how the bulk of people are thinking in a scenario like this if people see the market going up and how they are going to behave, right? If the average person sees price going up right here and they want to buy, where are typically most people going to put their stop loss? Well, some people might put it below this swing low, right? A certain percentage of people, if price goes down below this little swing low, they might think, okay, it's going to keep going down. I don't want to be involved anymore, right? But certainly a lot of participants in the market are going to put their stop loss below this significant swing low because their mindset is if price comes all the way down here, it's going to keep dumping, right? That's how most people are thinking. With that in mind, what do we have at these swing lows? We have resting orders, aka liquidity. Now, for context, anytime that we have liquidity resting below a swing low, we're going to refer to that as sell side liquidity. Anytime we have resting orders above a swing high, we're going to call that buy side liquidity. Those are the terms that we use to describe each set of liquidity. So in this case, what do we have? We have sell side liquidity because it is orders resting below swing lows. Traders who think if price comes down below this swing low, I'm out of the trade. This is my stop loss. Even more participants in the market are putting their stop loss at this low because this is a much more significant low, right? Now, in the eyes of the market makers, they don't just come up to their home office, open their laptop, click buy at any random point to fulfill their multi-million-dollar trade, right? Why? Because there's not enough liquidity here. Where is the most liquidity? Well, we just went over it at this swing low and this swing low. So what do the market makers need to do to fulfill their orders? They need to drive the market down to these significant swing lows to fulfill their buy orders to drive the market in the direction that they would like. Because when we have stop orders below these swing lows, that is resting sell orders, right? Imagine people bought into the market. So if they want to get out of it, they have to sell. So these are sell orders resting here. So you have a bunch of resting sell orders at these points that the market makers would like to draw to so that they can fulfill their buy orders to participate in the market. Because like I was saying before, if someone wants to buy something, someone has to sell it to them. Even the market makers have to abide by that same fundamental law, right? Now I'm going to make a quick example of this scenario playing out in the opposite way, right? If the market is starting to go down, a lot of people might want to sell here, putting their stop loss, which is a buy order at all of these swing highs. Okay. Remember, you can enter trades by shorting them, aka selling them, but to get out of them, you have to buy it back, right? So that would be a buy order, aka buy side liquidity. So what could we assume the average retail trader is thinking in this scenario when price starts ripping back to the upside? They're thinking, oh my God, this market's going to start going up. So what you have is their stop losses are starting to get hit because they were in short positions. They thought the market was going to keep going down. Okay. And now you have a new batch of the population that is thinking, oh my God, this market's going to start going up. So they enter buy positions. So right here is when the market makers are just salivating, right? Because they have a ton of buy side liquidity at these swing highs, right? They have a bunch of new participants buying into the market. So what are the market makers able to do? Manipulate price up to this key point in liquidity where all these resting orders are, fulfill them to then drive the market back down in the direction that they want. And this right here is the move we want to be involved in. Now, we're going to go through another example, but what is always happening at any given time when we look at the bigger picture of liquidity? Well, the market makers are always either generating liquidity or seeking liquidity. So constantly throughout the market at any given time, liquidity is either being generated or seeked out to be swept to move the market in the direction that they want to. Now, in case anything went over your head, just go through one more example here, and then we'll get into the charts. So we got this swing low. The market is starting to go back up. You got a lot of retail investors looking at this market saying, this is going back up. I want to get involved. Where are they putting their stop losses? At all of these swing lows. Various different participants with various different strategies look at the market in different ways, and they think if the market dips below any of these levels, I'm out. And the most significant of all of these is going to obviously be this one, right? Because if we go below this point, a lot of people are thinking, holy shit, I need to get out of this position so I don't lose even more money. A lot of people might look at this like it's some sort of support zone, and if it breaks below, they think the market is going to dump, which it could, but when we understand liquidity and reactions off of key points in liquidity, we can get involved in the market at the right time. Okay, so what do the market makers might want to do in this scenario? They just generated all of this liquidity on these little pullbacks here. They generated this significant pool of liquidity right here, which has potentially thousands of sell orders, right? Sell side liquidity, sell orders. So depending on their objective, before driving the market any higher, typically what will happen is manipulation. Filling all of these sell orders to then drive the market higher. A lot of people look at manipulation as some bad thing, like, oh, they're out to get me, or oh, they're cheating. No, we love manipulation. I always tell myself, if there's no manipulation, there's no trade. Okay, and I am actually going to write that down for you guys. So you can write that down, put it on your desk or whatever, but just remember, no manipulation, no trade. Because if the market just appears to be going up and there's no manipulation, that means the big institutions just really haven't got involved yet. The market will always go where the institutions want it to go. So if I'm just blindly entering in because I see price going up, oftentimes I am going to be the liquidity that the banks use to then drive the market in the direction that they want to go into, right? I hope all that makes sense. Now, let's go through some examples of this on the actual charts and we'll identify it on the actual market. So, looking at price here, where would we think that the most resting orders are? Well, you got these significant swing lows here, okay? You got a low right here, you got a low right here, and you got a significant low right here, okay? So these are all significant pools of liquidity, resting orders here. People see the market going up and they're putting their stop losses right here, maybe right here, and probably definitely right here, okay? So what did the market makers do here? Well, they generated a bunch of sell side liquidity. Now, if they really want to drive this market higher, what would you be likely to see before that happens? Manipulation. So let's see if we have manipulation. We do. Okay, the market is starting to trickle lower. So what are retail traders thinking here? Well, a lot of them are getting stopped out, right? Because when they entered their trades, they thought, well, if price goes below these levels, I'm out of here. I don't want to be involved anymore. On the flip side, there's other people thinking, oh my God, the market's going lower. I'm going to try to short this. Okay, so let's see what happens. Market makers generating liquidity here. All of these swing highs and swing lows are just manipulation. What did we just have right there? A big swing high? What could we look at that as? Buy side liquidity. All these points are buy side liquidity, this being the major one. Let's continue on. The market is continuing to drive lower. Okay. We have some more liquidity being generated. And what do we see happen right here? This low with all of these sell orders resting just got fulfilled. Okay. Now that doesn't automatically mean that we are going to reverse in the opposite direction. However, it is a good indication when you couple it with other confluences that this could be an area of interest, right? A key level to where we could see a reaction for price to then now deliver into the actual move. Now you might be thinking, well, there's these swing lows over here too. Wouldn't the market technically want to come down and grab those? Well, not necessarily. The market makers will always draw the market to the point that has enough liquidity for them to then take the market in the direction that they want to. So this here in this scenario is looking like it might be the place where they grabbed enough liquidity to then potentially drive the market higher, but we still have yet to see here. Now there's going to be a lot of other confluences that I could see right now that I haven't taught you that, such as this fair value gap or a potential SMT with ES. There's multiple things that could happen. We're not worried about that right now, but let's let this play out. What do we see? A break of structure to the upside, the market continuing to drive higher as we continuously generate liquidity, right? And what do? We hit our ultimate target, which is this buy side liquidity. So like I said a few minutes ago, the market is constantly generating and seeking liquidity, and we want to be involved in the market when we believe the market makers are seeking the next key level of liquidity. And the best part is you can go back and see this on any time frame. It does not matter. Right now we're on the 15-minute time frame. What do we have here? We have buy side liquidity built up right here. What do? We manipulate that level, drive the market lower. You can see liquidity being generated and seeked out at any given point. What do we have here? Significant swing low right here. Zoom in a little bit. We have some accumulation. We have manipulation to the downside, and up we go. Okay. We have another example right here. Swing low, manipulation to the downside. We take out all of those stop orders, drive the market higher. Now, it's important for me to also mention, just because we have a significant swing low somewhere doesn't mean that we have to reach that point to then have a guaranteed reversal off of it, right? You could see the market is continuing to drive higher, but we never touched this low. We never touched this low or this significant low, or this significant low right here, right? The market doesn't always need to trade back to every single swing high and swing low, right? Because if we did that, we would constantly just be going up and down. However, what we do have, let's take this swing low right here as an example. We haven't traded back to it, what appears to be yet, but what we have is generated liquidity. So if the market makers ever want to take the market back down to this point, they have resting orders to then fulfill their orders, and then they could take the price whichever way that they want. We want to be playing that game, not, oh, I think price is going up, I'm going to enter. No, we don't play that way. No manipulation, no trade. We want the market to be manipulated before getting involved. Always remember that. If you're brand new and you're scrolling online and you see people talking about the market being manipulated, that's great. That is how we make money. Okay, so I believe that I'm going to end the video here. We'll go through a little quick recap, and then I want to tell you guys what you should be doing until the next lesson. In summary, what did we learn today? What is liquidity? Liquidity is resting orders throughout the market. It is what the major players use to drive the market in the direction that they want to. We have infinite places of sell side liquidity and buy side liquidity that the banks use to fulfill their orders to drive the market the way they want. What I want you guys to be able to do in the meantime is just identify liquidity being generated and swept. And over time, you'll be able to get to the point where you could see it anywhere. What do we have right here? A swing high. What do? Manipulate it, drive the market lower. You know, you could see this happening on any time frame. Price will always be manipulated before driving the market in the true meaningful direction. So like I said, what I want you guys to do, just start identifying where liquidity might be in the reaction off of those certain levels. The more you can train your mind to look at the market in this way, the better off you are going to be, and it is going to help you tremendously in making a lot of money in the market. So thank you for being here. This might have been a longer lesson, but I wanted to make sure that I got into everything. Hopefully I broke it down as basic as I could. And if you have any questions, reach out to me. There will be a part 2 and probably a part 3 on liquidity, but I believe the next lesson will be on fair value gaps, so we could start forming an overall picture of how exactly we want to get involved in the market. So thank you guys again. See you in the next lesson.